Views expressed are solely those of the speakers and do not represent this show or its team.
We've seen geopolitical disruptions, we've seen tariff uncertainty, we've seen mixed economic signals from the Fed. The market did not hand anything to anybody this year. It has not been easy.
Welcome to Built to Last. This episode will be what we call our halftime report. I'm Lopez, and I have with us our Chief Investment Officer, Gary Aiken. Gary, how are you today?
Doing great, Wade. Great to be here, and we've got a lot to cover.
Yes, we do. We're midway through what has been a complicated and noisy and, quite frankly, fascinating year in the market. We want to slow it down, make sense for everyone, and talk about what it means for their financial plan. So, Gary, I guess the question for me is, when we look at GDP, inflation, the Fed, what's happening in markets, and what we think it all means as we head into the second half of the year, we're going to walk through our halftime report slide deck. That's going to include GDP, inflation, the Fed, what's happening in markets, and what we think it all means as we head into the second half of the year. So let's get into it. GDP inflation forecast. Gary, 6 months in, give me your honest read. Where does the economy actually stand?
There were a lot of concerns on Wall Street about what 2026 was going to look like. And we said that we thought that 2026 would look a lot like 2025, and that GDP would be about 2 to 2.5%, and inflation would be about 2.5 to 3%. And when we look at this chart, which is the GDP and inflation forecast from the Atlanta Fed, you can see that right now we're right around those numbers. And so we've had a good first half of the year with solid growth in the United States and rising inflation, mostly due to the rise in oil prices relating to the war in Iran. But generally within a decent range. And so the U.S. economy is in good shape.
So the growth number is positive. Inflation is trending in the right direction. That's a better headline than a lot of people were writing at the start of this year.
Yeah, I think so. And that's the way we're framing it for our clients, right? The economy is not in crisis. And we should expect that with the economy not in crisis, that should be a good environment for stocks and bonds.
So let's talk about incomes. And when we do that, let's go to levels a little deeper, because I think this is where clients live. Cooling inflation is good news, but it doesn't erase the cumulative pain people have already felt. We talked about the K-shaped economy on this show before. What does that data actually tell us about working families right now?
Yeah, working families are struggling with higher prices. That's for sure. And we've talked about that the accumulation of inflation is the real problem, not the rate of inflation today, although that has become more of a problem with 4.2% inflation in the most recent print. But what we're seeing is that if we look at a long-term perspective, like this chart that shows, U.S. personal income excluding transfer payments, that is, if we exclude people on Social Security, Medicare, getting benefits from the federal government, W-2 income employees, their incomes have not kept up with inflation for at least the better part of 2 years. And that is starting to bite when they make financial decisions and when they make decisions even at the grocery store. For individuals who have stocks and bonds and large investment portfolios, they've done great because the markets have been up. But for those who are working families who are dependent upon their W-2 income and maybe not as dependent on credit, it's been a tough situation. And so it's not all a rosy picture. And so we need to keep that in mind when we're looking at sectors.
Absolutely. I see this firsthand with clients. There's a gap between what the the portfolio is doing and how the client feels. So, Gary, how does that emotional tension show up in investor behavior?
It shows up in investment behavior with investors, especially when we look at things like the consumer sentiment index being negative. That folks think that inflation will be high for longer. They think that the economy is maybe doing a little bit worse than it is, and then they want to portray. Then they want to take that feeling and impute that on their investment portfolios. And what we're saying is that the market is a lot different than the economy. And so when we take a look at how we want to be invested, maybe we can be a little bit more bullish than some of these income figures would make us want to be.
And that's really the heart of what we do for our clients. Our job's to be that steady hand, right? To anchor them to their plan. We see that pulls them in this direction. It's not in their long-term interest. That's what built to last means to us, right? So let's move into Federal Reserve policy now. And I know there's, just had a previous show on that, but Gary, let's get into the Fed because this is the number one question I hear from clients. Rates, timing, what does it all mean? Walk us through where this thing stands.
So inflation has been rising during the first half of 2026, and really it started rising sort of in the summer of last year.
Mm-hmm.
And at the same time, the Fed was cutting rates. They've kept rates on hold for this year, as we said that they would. Right. Our initial view in our forecast was that the Fed would cut rates, but it probably wouldn't be until the second half of 2026 and maybe even late in 2026. I think that's still intact. But what we've seen is that inflation, the solid line here, and the Fed's primary inflation gauge, the core PCE inflation, is going up, and it's getting closer and closer to the Fed's current policy target. So inflation, core PCE inflation is 3.5%. The Fed's target policy rate is 3.6. So the Fed is actually becoming less. The Fed is becoming less restrictive over time. They don't mean to be, but they are. They're becoming less restrictive. And so you would think that if they wanted to get inflation under control, one of their policy tools would be to increase rates so that they would become more restrictive. I think that's the base case that we've got to think about when we think about next year, which is, or the rest of this year, which is that inflation is going to be a primary component and interest rates may have to stay where they are for longer.
So I just heard you say that rates staying higher for longer is still the base case. Is that correct?
That is the base case. And what that means from a practical environment is that we want fixed income portfolios to pay out at a higher current yield. We want to be short duration, like we have been, and we want to make sure that we're limiting the volatility while maximizing current yield.
And for clients who've been patient, who stayed invested, who stayed the course, right? They are the ones positioned to benefit from where we go from here. So let's talk about markets and strategy. Let's shift to, what's going on in the first half of 2026 has been a story of resilience. It's been a straight line, right? Kind of. So set the scene for us.
Yeah, I would say it's been anything other than a straight line. This has been a year where you have had to earn your return. And, we've seen geopolitical disruptions. We've seen tariff uncertainty. We've seen mixed economic signals from the Fed. The market did not hand anything to anybody this year. It has not been easy, but investors who have been disciplined, who have not panicked, and who did not try to time things have captured gains that have accrued to investors this year.
Right. And you constantly say it's going to be a grind, even named it the grind, but just because it feels difficult doesn't mean we should get out of the market, right?
Yeah, that's exactly right. This means it's not going to be a scenario like 2021 where everything went up and it felt easy, or 2022 where everything went down and it felt difficult. This has been a grinding higher market, and that's what the
Right.
grind is. We think that markets are going to grind higher, and what we've seen this year is that for the first half of 2026, we've seen that global stocks have been up about 10%. The S&P has been up about 8%. Um, and small caps have been up 20%, and international stocks have done about 12% returns. So, despite the geopolitical crises around the world, despite oil prices, despite all the headlines, markets have done a fairly good job of digesting that and focused on the actual strength in the global economy.
Our thesis has been consistent. Stick with it. Stay invested. Trust the plan. And I want our clients to hear that message clearly. The grind is real, but the grind rewards the patient.
Yeah, that's exactly right. The returns on this slide look terrific, and they are, but it has not been easy, and I don't think that it necessarily needs to be easy for it to be worthwhile and to stick with it.
Let's move on, to the bonds and the yield, and let's talk about, my my favorite discussion, bonds, which I'm passionate about not talking about them most of the time, but we have to. And the yield curve is one of those things clients hear us talk about, but don't always fully understand it. Not that I ever do either, but break it down for us. What shifted and why should people care?
Wade, I know you secretly love bonds,
Yep.
and
Love them.
that can only be the reason why you say you dislike it. But what this chart is showing is the yield curve at the beginning of the year, and the yield curve is the rate of return on various treasury bonds from 3 months out to 30 years. And so we look at that and we see that, we thought that potentially at the beginning of the year that the curve would steepen further as short-term interest rates went lower. Well, inflation surprised on the upside, and so what happened was a little bit different. Interest rates on the high end of the curve, on the long end of the curve, did go up, right? 10-year yields went up, 20-year yields went up, and 30-year yields went up. But the 2-year, the 5-year, the 3-year all went up as well because inflation expectations got baked in a little bit higher.
Yep.
And so, it's been a tough year for bond investors. The bond indexes are basically flat to maybe up 1% on the year so far. And so it's been a tough year for bond investors.
Well, put it in terms our clients can feel. What does a higher, flatter yield curve actually mean for someone's financial plan?
It means a couple of things. First is if you are depending upon current income, you don't have to take a whole lot of risk. You can go out to 2 years and you can get 4%
Right.
or more on your money. And that means that you don't have to take a ton of risk to earn some current income to support your lifestyle.
Yep.
That's a positive. Second,
That
it means
is.
that borrowing costs for business loans, for consumer credit, they do remain elevated, and that's somewhat of a headwind for future economic growth. And the third is it's a reminder that the interest rate environment that we build portfolios in is one where we are thinking about this idea of building to last. Fundamentally, the bond market has changed.
Yep.
And so we're making sure that we're positioning accordingly.
Yeah, and you've done a great job doing that, especially on keeping us in I would call it a conservative holding pattern. So, and to me, this is where having a comprehensive plan matters because how you hold fixed income, how you think about duration, how you balance your portfolio, all that had to be calibrated to where rates actually are, not where they were, right? So let's shift over a little bit and let's talk about energy. You and I talked a lot about the geopolitical picture this year. Seemed like every day. Energy is special, right? Oil has been all over the place. What are we watching, and what does it mean for the second half of this year?
Yeah, the price of oil is very important to global trade and inflation. And the main question is this war in Iran really over? Is the Strait of Hormuz really going to open? Have we found enough workarounds, whether it's pipelines or demand destruction or shifting supplies from the Middle East to the U.S. and other places? Um, are we done drawing down our strategic petroleum reserves around the world? And what we can see is that during the first half of the year, oil spiked higher. It didn't get to the point it was during the peak of the Ukraine war, and you can see that that's the dark blue line is the price of oil in West Texas Intermediate, and what we can also see is that once the ceasefire was announced, oil has dropped precipitously, and now with this MOU in place, oil has come all the way back down to about $70 a barrel, and so the price of oil, the price of gasoline, the price of jet fuel imputed into inflation is backward looking. And so to the extent that, oil stays here around 70 or maybe even drifts a little bit lower, that will mean that future inflation will also be lower. And that can be a tailwind for markets, despite, as opposed to being a headwind for markets in the first half of the year.
Yeah, and the trade piece is connected. Global supply chains, energy costs, tariff policy, they all interact, right? This is not background noise, it's real input into where inflation goes in the second half, which feeds back into the Fed policy, which feeds back in the markets.
Yeah, that's exactly why we manage portfolios with a comprehensive macro view. We're not just looking at stock charts, but we're trying to understand the fundamental picture from a global macro perspective down to countries and sectors and individual securities.
Yeah, let's segue that right into valuations, right? I like this topic because this is where I get a lot of questions from my clients about, hey, wait, is the market too expensive right now?
The honest answer is that the market has gotten a little expensive again,
Mm-hmm.
but we have been here before, um,
Yes.
and uh, and the valuations do matter, right? We should see a response to high prices being high prices. The in the oil market, for instance, there's this old adage: the cure for high prices is high prices. And so markets will tend to find these high levels and then find a reason to sell off a little bit, some profit taking or something that's something else in the short term. But
Right.
over the long term, what we see, the solid blue line is the forward earnings expectations. What we see is
Mm-hmm.
that forward earnings expectations are actually pretty well contained. That the S&P 500 is trading at about 20 times forward earnings, and the rest of the world market is trading at about 14 times earnings. So, and we think that earnings growth is real and believable here. The global economy is in good shape. Oil prices are coming down. That should lead to more trade. That should lead to, and the global AI boom is still in place, and a number of other infrastructure items are going to lead to higher growth. And so if those earnings materialize, we think that we can continue to grind higher despite the S&P being close to its top of its valuation range.
Yeah, but the market being expensive for good reason doesn't mean there's no risk, right? So, as our chief investment officer, what's keeping you up at night?
Yeah, I see three big risks to the outlook.
Mm-hmm.
One risk is that earnings disappoint.
Right.
If companies can't deliver on what the market is expecting, we could see a correction. That's
Mm-hmm.
always a risk in a high multiple environment, which is why we're not chasing momentum right now. We're focused on quality. We're focused on companies with durable earnings power and on portfolios that can absorb that volatility.
Right.
Another risk is that inflation gets out of control. Maybe this reprieve in oil prices, is very short term, and oil prices spike again. Maybe the underlying inflation in the economy from the AI boom continues to make core inflation sticky. And so interest rates maybe have to continue to go up, both in the short term and long term. Those kinds of things will definitely impact discounted cash flows and valuations. And so that, inflation and interest rates are always an important risk. And then finally, geopolitics is the other elephant in the room. We're ending June 2026 with a fragile ceasefire and negotiations in Iran, low global oil reserves, Ukraine on the edge of having the upper hand against Russia, and important elections coming up for the US, UK, Israel, among others. And the second half of 2026 is going to be anything but boring. So geopolitics is always an important risk for market fluctuations.
The right lens for the second half of 2026 is built to last, right? That's what we're doing here. And so let's land the plane as we head into the second half of 2026. What is the message you want clients to carry with them?
I think the message we want to stay with clients in is stay the course, trust the process. The economy is growing. Inflation is going to start moving in the right direction. Earnings are continuing to rise. So this is not a time to abandon discipline or give in to your fears, especially as we get into the silly season of elections. It's a time to be rewarded for taking prudent risk.
Yeah, I couldn't say it any better. Halftime report for 2026 is this. We grinded higher even while the macro was complicated and investor sentiment was fragile, but clients who stayed anchored to a comprehensive plan, who tuned out the noise, who partnered with a fiduciary team, those are the investors who win in the long run. If this episode raised questions about your own plan, we want to hear from you. Reach out to your advisor, Concord Wealth Partners. We'd love to have that conversation. Thank you for listening to Built to Last. Gary, pleasure as always.
Looking forward to a great end of 2026, Wade.
That's fantastic. And we'll see you next time on Built to Last.
This podcast is produced by Concord Wealth Partners, LLC, an investment advisor registered with the Securities and Exchange Commission. Registration does not imply a certain level of skill or training. The information presented is for educational and informational purposes only and should not be construed as personalized investment, financial, tax, or legal advice. Nothing discussed should be considered a solicitation or offer to buy or sell any security or investment product. All investing involves risk, including the potential loss of principal. Past performance is not a guarantee of future results. Individual results will vary based on personal financial circumstances, risk tolerance, and other factors. Concord Wealth Partners does not provide tax or accounting services. Tax and accounting services are offered through Concord Business and Tax Advisory, an affiliated CPA firm. For more information about Concord Wealth Partners, including our Form ADV Part 2A and Form CRS, please visit concordwealthpartners.com or contact us at 800-838-4370.